primarily, when you're trading options, these are the Greeks that you really need to be most concerned with, okay? So we talked about delta and gamma last week. So just as a review, delta is your options expected change in value with respect to a $1 move in the underlying stock price, okay? So how much your options expected to change, either up or down, with a move in the underlying. Your gamma is, once again, your going back from last week, is the speed of your delta. So how many deltas I will pick up on the upside or I will lose on the downside, depending on whether the stock moves up or down. How many added deltas I'll either pick up or lose based on a $1 move in the underlying. Now, theta, which we'll talk about today, is your option sensitivity to changes in time. In other words, how much my option's going to lose every single day with every single day passage of time. So remember that when we're trading options, options have a finite life. Unlike stock, you buy a stock and until the day you sell it or the company goes bankrupt, you own an ownership piece of that company. Well, options, you're just buying and selling rights and obligations. You have no ownership in that stock. So at a certain point, that option ceases to exist, whether it expires in a week, a month, 3 months, 2 years. At some point, every option has comes to the end of its life. So every single day, that option loses a little bit of value, and that's what theta is. Now, vega, which I consider probably one of the most important of all the Greeks, is your options sensitivity to changes in implied volatility. We'll get into implied volatility later in the presentation, but this is a really crucial Greek that you really need to wrap your head around. It's very important. And rho, lastly, rho is your options sensitivity to changes in the risk-free interest rates. In other words, how much my option contract is expected to increase or decrease based on changes in interest rates. So once again, in review, so the Greeks, once again, are only meaningful during an option's lifetime, okay? Because remember, at expiration, the Greeks disappear because at expiration, there can only be two outcomes. Either that option is in the money and has intrinsic value, or it finishes out of the money with no value. Those are the only two outcomes that can happen, okay? So on expiration, at the end of the trading day, there are no more Greeks in that option. It's either stock or it's not. Now, Greeks affect, a change in the Greeks affect other Greeks, okay? So changes in an option's time will have an effect on its delta. A change in an option's implied volatility, which we'll kind of look at later on, can have an impact on the option's theta as well as an option's delta. Now,